the trick that they have learned is to try to stay within those areas where they can be really good.
It says we don't know where interest rates are going to go. We have our bank is set up. If interest rates go up, we do fine. If interest rates go down, we do fine.
Because everything goes up to the right for 8-9 months and then boom, something happens and voila, that does not happen anymore. And oh, this is hard. All right, folks, welcome to Investing for Beginners podcast. Today, we're going to talk about the 12 things I wish I knew when I first started investing. We got a great list here, and this is going to be a lot of fun. So let's go ahead and dive into the first one, which is it's not easy to beat the market. And amen to that. So, Andrew, what are your thoughts on it's not easy to beat the market, and why did you wish you knew this?
Well, I wish I knew it because my expectations for myself would have been a lot lower. And so I would have been a lot less disappointed when I started to lose to the market. We all did it. I did it. You grow up, quote unquote, you grow up on your Buffett and Munger and your Ben Graham and your Graham and Dodd and your Peter Lynch and your Joel Greenblatt. And it's easy to identify with them and start to think, yeah, I could be just like them. And I will be just like them. And then that can bring an arrogance, especially because I know this is going to happen. You're going to buy a stock and it's going to go up and you're going to think you're a genius. And with the wrong mindset, that can be dangerous. I mean, everybody's on different paths of their journey. So if you're just starting, whatever, maybe it doesn't impact you. But let's say you go into professional money management or something. And if you haven't really internalized that it's not easy, complacency can really breed a lot of pain in the stock market. And you'd be shocked how some things don't change very much, but some things do change very quickly. And so I think having the mindset going in, like, it's not easy to beat the market. Maybe I'm even going to approach it like, I will lose to the market. I will underperform. Maybe it makes it better because that can almost drive you towards constant improvement. And I look at some years where I thought I had it all figured out. It's just like a wasted opportunity. I could have learned so many things during that time that I didn't because I thought I had it figured out. So that's why I wish I knew it.
I wish I knew it too, because yes, it is hard. And when you first, you get lucky and you buy a company like a Microsoft right out of the gate, which does well. And then maybe your second pick for me was, oh gosh, the gaming company that Microsoft bought. I'm blanking on the name.
Activision.
Thank you. That was my second one, and that went to the moon. And
Yeah.
then the next three I bought were complete dogs. Lost 75, 85% of what I paid for them in a very short amount of time. We're not talking years, we're talking months. And I realized very quickly I was in over my head, and it's not easy to beat the market. Even though the people I was reading about were doing it with ease, seemingly, not understanding the effort and hard work that goes behind it. So youth carries with it a lot of enthusiasm, but also sometimes a little bit of arrogance too. And sometimes the market is there to teach you a lesson. And we all have to get our education in the market, and that is what happens. And like you said, depending on when you enter, can have a bearing on it's sometimes good to lose early on, because then you learn, okay, hey, this isn't easy and I need to step up my game instead of just I buy it and it goes up to the right. There has been periods of time more recently where I think a lot of retail investors have thought, oh, this is easy. Why does everybody think this is so hard? Because everything goes up to the right for 8-9 months and then boom, something happens and voila, that does not happen anymore. And oh, this is hard. So I think I wish I knew that when I first started.
Yes.
So the next one we had was the math is easier than I thought.
That was yours, right?
Yeah, that was mine. So I admit when I first started thinking about investing and the whole stock market thing, I had visions of higher math floating through my head. I thought honestly that there was going to be lots of derivative level math, which I still don't know. And I thought that that's all it was going to be. And that finance was very, very hard. And there was lots and lots of numbers, which there are lots of numbers, but the actual math is way easier than I thought. If everything you basically learned in fourth grade is what's going to translate to what you need to do, i.e., adding, subtracting, and doing some division and some multiplication. And that's about the extent of it. It's not hard. It's not easy. It's not easy in that finding the numbers, interpreting what they're telling you, is a challenge, but the actual math itself is way easier than I thought it would be.
Did you start looking at course material like, okay, which math classes do I have to take at my
Yeah,
community
pretty
college?
much. Yeah, pretty much. I remember going on Google and asking, what kind of like math do I need to brush up on or take to become good at investing or finance? And it all basically came back saying you don't need that much math. So
Right.
and that was like, oh, okay. And then when I actually got into the air quote formulas and things, then I discovered that, oh yeah, this really isn't that hard. When you're trying to figure out the PE ratio or return on equity, it's basically plugging in numbers and dividing, which is not higher level math. DCFs involve a little bit of algebra, but it's not complicated algebra. So to me, that's yeah, it was a bit of a shock.
And what's nice about those DCFs is we have Microsoft Excel.
Oh
And
yes.
so you got the right tool in your toolkit, you know?
hmm
It's like bringing a power drill instead of a nail and hammer.
Right.
Can do a lot and make it a lot easier for you.
Yep. So then the hard part becomes the numbers and trying to interpret them, but that's a whole other conversation.
Right. Well, my next thing I wish I knew when I first started investing is that there's a lot to learn and you don't know what you don't know. That sounds depressing and maybe it can even sound overwhelming. But I think in that there is a lot of, again, I guess it's kind of sounding like the first point I made, but being closed minded and not being open to learning and constantly improving is just a recipe for disaster. And when you don't know what you don't know, you have a little bubble. I don't know if you ever watched SpongeBob. Sandy Cheeks lives in the bubble, the
Yep.
squirrel.
Yep.
Yeah, that's your little bubble when you first start investing, and it does get bigger over time. But that outside ocean is very scary, and the blind spots can really catch up with you in ways that can be, again, very painful. So you have to choose, do I want to learn from the school of hard knocks or do I want to try to prep myself to not have to make those mistakes? So to me, going down the route of learning about history of the markets, history of economies, history of interest rates like a freak. All those things I think have helped build a base of foundation to be able to avoid some of the other hiccups that have swallowed up other investors who are maybe a little less cautious. But at the same time, also a lot of finance things that I thought I didn't need to learn that, like cost of capital, that was a mistake, or the intricacies of return on invested capital. Yeah, should have learned that one too. So those are all things that it's like, okay, when you don't know what you don't know, maybe it's easier to be, maybe you can look at it like I'm gonna work up to my boldness rather than just coming out of the gate and being like, I'm gonna do it all. I'm gonna YOLO it all on this two companies. If you can do it like, okay, I'm gonna earn the right to YOLO or something, maybe that can help with long-term returns.
Mhm.
Those are the things like, yeah, I wish I picked up Domadoran stuff in 2013 rather than 2020. I feel like I would have been so much more ahead. And
Mhm.
maybe I could have been in Amazon. Maybe I could have been in, I don't know, Apple before it blew up. Now I'm just in Apple like an old man who just finally downloaded Facebook or something. Like, yay. I think it'll still do well, but like there was so much missed potential there that if I just would have expanded my horizons, I could have found more opportunities.
I mean, like anything, when you start off, you don't know what you don't know, and so it it isn't until you start getting some experience, till the market slaps you around a little bit, that you start to go, "Oh, I really need to know this," or "I need to understand this better before I can become a better investor." And reading the early books can certainly help you. The Peter Lynch books and investing, The Intelligent Investor, and things of that nature can certainly be helpful and very instructive. But even those are not going to tell you everything that you don't know that you're going to need to know. And something that I guess I didn't realize how important it was to understand the business. Yes, I heard Warren talk about that in his shareholder letters, and I heard him talk about it at annual meetings. but I didn't really get it until I started making poor choices on companies because I didn't understand how they made money and how important that really is. And until you actually figure that out, you don't know. Okay, hey, I love Starbucks. Okay, I'm just going to go buy Starbucks. But if you don't understand customer behavior and how they make money and what drives people to come and fork over their $5 to $7 a day for a double cafe latte with whipped cream, light cream, blah blah blah. I'm making stuff up, obviously. That you don't know how important that is until you don't know, and then you're okay, this is important. I need to understand how these businesses work, and now that's my favorite part of investing is figuring that out.
Yeah, totally.
So you also talked about the money slash returns will come. What were your thoughts behind that?
Let's play let's play a numbers game because everybody loves when I do that, I'm sure. There's probably like
Ooh.
dozens of people who are rolling their eyes at the moment. Okay. So let's say you wanted to make $1,000 from your investments. When you have $1,000, let's say you're first starting out, your portfolio is at $1,000. To make $1,000, you have to double your investment. Okay. If you have $100,000, $1,000 is 1%. That's like the difference between 10% return and 11% return. 1%. That's your $1,000. So as your portfolio gets bigger, the ability to make money from that portfolio gets exponentially bigger. And those decisions get, I guess, exponentially more important depending on I say I guess like it's like
I guess.
some mystery. So, with that in mind, like if you're disappointed that your portfolio is so small, you won't be really disappointed. You could go look back in my archives for the newsletter and you can see when my portfolio was $150,
$300.
$800, $1,000. Like it's been a really slow grind. And
Mhm.
that's even with the power of compounding. So you might look at your portfolio and be like, I just want to be like Buffett now. I want to have 700 million in dividends every single year from Coca-Cola investment. Chill, relax. That stuff will come, but yeah, it will take a long time. And so
Mhm.
just enjoy it.
Mhm. Yeah, enjoy the journey, enjoy the learning, enjoy the fun of getting to participate in one of the greatest things on earth is the capitalism and the way businesses make money is it's endlessly fascinating and it's a lot of fun. And yes, it does take time. You got to be patient. And that's another thing you can learn from the market that I think most people don't know is that you have to be patient. And the greatest ones that have done really well, the people we all talk about as examples are all patient, infinitely patient people. And I think that's one of the things I didn't know about it. So we could add that one if we wanted to.
Yeah. Well, I always think that like next year will be the year my portfolio just hits it big. And I've
Right.
had to relearn that every year, the turn of every year. Okay. Yeah. Be patient.
Yeah. This is the pick that's going to put me over the edge. This is
Right.
the pick.
Exactly. This is
Every
the
month, this is the one.
one. I have not said this 125 times
Right. This is
already.
the one. This is the way. This is the one.
So you have one which I really liked. I mean, we can dig into this for a little bit because I think there's a lot here, but selling is harder than buying.
Yeah, I wish I knew that when I started because I honestly thought, before I really got into this and really understood what it is I was doing, the the emotional pull to sell something is way harder than it is to buy something. And there's so many layers of the onion you can pull away from this, but the loss aversion bias, the idea it's a hit on your ego that when you sell, you're basically admitting defeat. Like I put all my hard work and effort into buying this company and it has not turned out how I thought it would. And so now I'm going to sell it. And so now your ego gets chipped away just that little bit because you have to acknowledge that you were wrong, and that's a really, really, really hard thing to do. And emotionally, it's a lot easier to go, well, yeah, it's down 78%, and I've only owned it for 3.5 months, but it can come back.
Right.
and you hold on to it waiting for it to come back, and the waiting for it to come back is even harder than it losing money because it just takes that much longer, and mathematically the return that it has to get to equal out, even just get the back to break even, is not 78%, it's 192% or whatever the math is. So it's exponentially bigger. And so you don't know those things until you know them. All those things go into making it so much harder to sell than when you buy something. When I first bought my first stock, when I first bought Microsoft, I remember thinking, honestly, hey, if this doesn't work out that great in a month, I can just sell it and not a big deal. But I didn't have any, I mean, I had skin in the game because I was putting money in it, but I hadn't done like any sort of work on it. But once you start reading 10 years of annual reports and poring over financials and spending endless hours watching YouTube videos about how this company makes money, or looking at customer reviews of the products, and you wrap up, I don't know, 50 hours of your life into buying a particular company, and then you want to sell it in 6 months, that's a lot harder place to be than I first thought. And I wish I would have known that, because I would have set myself up mentally that, hey, it's okay to accept a loss and move on.
Yeah, I think you can be a lot better of an investor if you do that,
Mm-hmm.
because if you can somehow free yourself of that pull, then you can, rather than being defensive, like, well, I'm going to hold this company till I go down 6 feet under. You can say, did something change? You go
Mm-hmm.
from a defensive stance to a curious stance. What can I learn from this? And a lot of times I try to do that with my stocks. And I think I've gotten better over time, but it's still hard. But
Mm-hmm.
pretend you were wrong, and then be like, oh, well, maybe I'm wrong about this. So let's go learn more. And then you just build those mental models that you can use
Mm-hmm.
for other companies. Also, it's not wasted work, because if you do find out that, oh, I was right, and I also know this much more about the business, that's a deeper level of understanding
Mm-hmm.
that is hard to front load. I mean, you can try to front load as much as you can, and I certainly do, but um, yeah, it's not easily obtained information. If it was, we'd all have it, and we'd
Right.
all know exactly which stocks to buy and which stocks to sell.
Right.
So this is one of those, to me, that's hard to do. I still struggle with it, but I think that there's a lot of meat on this bone. If you can figure it out and master it and internalize it, I think
Mm-hmm.
you can become so much better of an investor
Yep.
if you can figure that out.
Yep. I agree. And I think I I don't know this for a fact, but I would guess that some of the great investors that we all admire and try to learn from have probably gotten a lot better handle on this than newer investors, or particularly new investors. I think that's one of the things that probably sets them apart, is they're a lot quicker to realize a mistake and cut their losses and move on.
Like Buffett with IBM.
Yep, perfect example. He was wrong. He admitted he was wrong, and he cut bait and moved on.
Yeah, the one that I'm like, it actually almost gave me butterflies or tinglies just thinking about it. But how you helped me move away from Franklin Resources and
Oh
move
yeah,
that money into Visa.
yeah.
I was like, oh my goodness, that's like getting dirty in a muddy pit and then jumping into the cleanest spring and just coming out so sparkly and refreshed. Like, in hindsight, that was wonderful.
Yeah.
But if you hadn't helped me through, like, oh, maybe you were wrong on this,
Mm.
I probably would have still held it, because you can always make justifications for holding something. You could
Oh
say,
yeah.
well, they're still paying a dividend, or
Yes.
oh, they're going to turn this around, or this margin thing is temporary.
Right.
Sometimes it is, and sometimes it's not. But
Right.
you don't know what you're missing if you're just
Mm-mm.
if you're doubling down for no good reason other than just to double down. That's probably not a good reason.
Yeah. Totally. Yeah. Totally. All right. So the next one you put up here was, there's nobody who knows everything about Wall Street. There's a lot here in that one.
I mean, there might be a lot on the page, but not much going on upstairs. So, uh, to me, this idea is just, it's a little bit liberating, because I think Wall Street can be very intimidating, and for good reason. There's a lot of smart people who play
Oh
this
yeah.
game, and there's, like we've said, endless things to learn about. And Yeah, I mean, some people just have advantages over us and they'll be better investors than us, and you just kind of have to accept that. But at the same time, there's not anybody who knows everything about all of it. And so that means that every investor that we're competing against has blind spots. When everybody has blind spots, that creates opportunities for everybody else. When you start to learn about how smart people are in this field and the kind of expertise and circle of competences they have about Jamie Dimon in banking or Jerome Powell with the Fed, like everybody has their area where they're
Mm,
just the expert. But even those guys, they don't know what's going to happen in the next 3 months, 6 months. I think one of the coolest thing I learned about Jamie Dimon, other than all the great things he's done and the great track record he has, is he says we don't know where interest rates are going to go,
mm-mm,
so we just prepare for both scenarios. We have our bank is set up. If interest rates go up, we do fine. If interest rates go down, we do fine. And I'm like, huh. Like all these bank CEOs and all these different banks, there's thousands of banks. They're
mm,
all trying to take advantage of what interest rates do, where they think the forward yield curve is. People are betting on it now. On I don't even remember what the platform name is.
yeah.
Everybody thinks they know where interest rates are going to go. Jamie Dimon says, "Nah,
Mm,
we're just gonna set up our bank so that we're gonna be fine no matter what interest rates do."
mm,
When we can start to think in that way, I think it to me it's inspiring because it's like, all right, I can find my own little going back to the dome. I can find my own little dome of
mm,
expertise and my own little areas where I see opportunity and I can take advantage of those.
mm.
And at the same time, I don't have to listen to other people who are so convinced that they know this person said that thing, and so, we're gonna see a crash tomorrow. It's like, no, you don't know that.
Mm-mm.
And you can avoid a lot of BS from understanding that people don't know the future, and you can save yourself a lot of stress, and you can find opportunity. So, I don't know if this necessarily hampered me in any way, but it was just one of those things when I learned it, I was like, "Oh, cool, cool. We do have a shot at this. There is opportunity out there." So I like that, and that brings me comfort.
It brings me comfort too. And I think when I first got into the game, I really thought that a guy like a Joel Greenblatt or a Peter Lynch knew everything about the stock market. And it wasn't until I got more into it that I realized that they certainly know a lot and they're way smarter than I'm ever going to be. But they also have, as you put it, blind spots. They have areas that they're just not good at. And there are things that they aren't going to be as excellent at others. But the trick that they have learned is to try to stay within those areas where they can be really good and try to avoid the areas where they don't. And that is something that I didn't know. And I just thought that, these guys, these people know everything there is to know. And if I just emulate them, then everything is going to be fine. And that's not always the case. But I think it's also helpful to understand that. And I wish I would have known that going in because it was a little bit too much of the like, okay, I can drink the Kool-Aid and I can, just do this and follow this and I'll be fine. It's no, there's a little more to learn about it than I originally thought.
Yeah. Yeah, totally. That's good. That's a good one.
Mm.
I recommended a stock a couple years ago that's up pretty big. I want to share that with you so you can see the type of analysis that I do for paid subscribers. Download it for free at stockwriteup.com. All right. So the next one you do have to learn accounting. Okay. You're going to lose people now.
Yeah, I know. Sorry, wah wah. But as Warren Buffett said, accounting is the language of business. And if you want to invest, you are buying businesses, plain and simple. And so you do have to learn a level of accounting. I'm not saying that you have to understand the finer details of FIFO and LIFO and things of that nature, but do need to understand how financial statements work, how they connect, and what the different line items mean and their impact. Basically, you need to be able to read numbers like you would read a book. What kind of story are they trying to tell you? And how can that help you become a better investor? And I did not know that. And I wish I had known that because I would have actually paid attention to my accounting class when I was in college.
Yeah.
So the next one you have is buybacks are not bad.
Yeah, they are. If you're a shareholder, usually they're not a bad thing.
Mm,
I don't know if this was just reflective of the time. My first stock I bought was in 2012. I first really started getting serious into this in like 2013. So I don't know if that's just reflective of the time period, but it felt like there was a lot of negativity around buybacks.
Mm,
And I'm not just talking about like from the general public, but I mean even investors were saying, "Well, the CPS growth isn't real because it was all buyback driven."
mhm,
And I believed that for a long time because again, I didn't know what I didn't know. Even some of those things like Buffett's written so many he's written about so many topics.
mhm,
And as I've grown as an investor, I've started to absorb more and more of what he has taught. But for whatever reason, the whole buybacks thing just flew over my head. I never thought to think about what he was saying. But I think he said several times that uh, either buyback or versus dividend is almost the same, or he prefers it for tax reasons.
mhm,
When I started to learn about buybacks and earnings per share and how stock prices follow earnings per share, and just that idea, your slice of the pie gets bigger when a company does a buyback. That I think would have been nice because I've missed some opportunities. Now I'm definitely pro buybacks. That's no secret. When you look at my newsletter, you see some of the
mhm.
stuff in there. But it's something in the past 5, 10 years, we've seen some companies who have been masters at buybacks.
Yeah.
Home Depot, Domino's Pizza,
Mhm.
AutoZone,
Right.
NVR,
Yep.
those guys, the 2010s goats, right, of
Right.
buybacks. Would have been nice to be in names like that during that time period. So you live and you learn. It is one of those more dangerous narratives that gets thrown around by smart investors. And it's like, well, take a valuation class or something.
Understand the impact.
Yeah.
The next one you had was don't be dogmatic.
Mhm.
What were you trying to get at with that one?
Very similar to what I was just saying. It's natural for us to want to identify with ideas and types of investors. So I grew up in Southern California, so I'm a Dodgers and a Lakers fan. I'm all about that, right? I love to identify like that. In the stock market, we see that with people, and they usually make that identification pretty quickly. Either you are a value person, or you're a dividends person, or you're an indexer, or you're a growthy, or whatever the flavor of the week is, you're a meme coiner,
Mhm.
whatever. Uh, so for me, I've very much attached to being a dividend and value guy. That closed my mind for a while. Of like I said when I wrote up Markel a few months ago, I sucked my
Like,
thumb way too long on this business because I've been so dogmatic about my dividends approach.
mm,
I'm still 100% pro dividend and pro buybacks and all of those things, but that's not everything, right? I think it's okay to break out of those dogmaticness because in the world of investing, I don't think being dogmatic is a good thing. And to have a dogma you're following it to a certain extent is a good thing because you want to have rules that help you stay on the right course.
mm.
But trying to follow it so strictly, like I'm going for perfect attendance, I don't think it served me well.
I was lucky. Those are all great points, and I think I was lucky in that coming from a music background, and some of my favorite musicians were people that weren't dogmatic about their influences, i.e., Jimi Hendrix, my one of my heroes, Stevie Ray Vaughan, another one of my heroes. They were open to getting ideas from just about anywhere, whether it was country music, whether it was folk music, whether it was blues, jazz, Indian Eastern music. Any of those kinds of things, they're open to taking pieces of those and putting them in their music, and so they weren't super dogmatic. And so when I got into investing, it was helpful. I think I was probably more open to being like, okay, so what are growth investors doing that maybe I could take from? I remember our conversation. I mention this all the time with Timothy Sykes, who is a big trader. What could I learn from him? Super smart guy, way more disciplined than I expected. And so what could I learn from him? I don't know that I necessarily picked anything up, but at least after talking to him, was open to going, okay, what could I learn from this? And I think that can be super, super helpful. I agree with you that that having a structure and having a certain level of dogmaticness, if that's a word, it is really good to help keep you grounded and on track. But yeah, I think having some open mindedness to like at least go, okay, maybe I can pull from this or maybe this kind of thing. And maybe that's some of Charlie's influence on me as well, as he was kind of that for Warren, I think.
And it's funny you bring up Warren because if you look at the Apple investment,
Mm,
one of Warren's dogmas for a very long time was I don't touch tech stocks.
yep.
And then he broke that seal by buying IBM. And
Hmm.
then luckily when the Apple opportunity came around, he did not shy
Hesitate.
away from that one. So,
No.
and you could argue that's been one of his best decisions of this millennium.
Yeah, for sure. Yeah,
Yeah.
yeah. It worked out quite well for him and his shareholders.
Yes. All right. So you have valuation matters.
Yes, valuation matters. I wish I had known this. The price you pay matters. And if you pay a poor price, you are going to get a poor return. Now, there are people out there that will say, oh, yeah, Dave, if you hold it for 20 years, it doesn't really matter. True. But to get to that 20 years, you got to endure a lot of ups and downs. And if you buy at a good price, it's a lot easier to endure those ups and downs than if you pay, if you buy a company and you overpay and that position is down for 7 years before you start to see a positive return. I challenge you, A, to show me in numbers that you did it, and B, I don't think there's a lot of people on the planet that would be able to do that and be serious long-term investors. So the valuation matters, the price you pay matters, and there's lots of different ways you can go about valuing a company, and that's not really the conversation. It's more about understanding that you can't just buy anything at any price. There has to be a good price that you have to pay that's a fair value for whatever it is you want to buy. As I said a million times, you buy a car, you buy a house, you want to pay a good price for it. Same thing when you buy Apple, you want to pay a good price for it. And that will go a long ways towards you holding it for a long time, as well as getting a really, really good return over a long period of time. So I didn't know that when I first started. I just figured you could just buy whatever, whenever, and it's all going to go up eventually, right? So it doesn't really matter. And I learned that the hard way very, very quickly.
Yeah. Yeah. I'm still learning that sometimes.
We all are. It's a constant learning game. Hey, this is awesome. I really want to buy it, and I'm just going to pay whatever. Yeah, usually doesn't work out well.
Yeah. My version of paying whatever and other people's version, I think, is a lot different.
Yeah, probably. Yeah, yeah, probably. I would agree with that. The next one I threw on the pile was volatility will happen. And I don't think I understood at the beginning, and I wish I did, how much volatility there really is in the investing game. And you will see companies that you own fall and drop, sometimes for reasons of their own doing, and many times of reasons of nothing to do with them whatsoever at all. And that is part of the game. It's not a bug, it's a feature. It's just part of the game, and you have to learn to have, I think Peter Lynch said part of success in the market is having a strong stomach. And I think that really goes to that idea of volatility will happen. You will buy something, it will go down. Usually I try to give everybody a heads up when I buy something because it usually drops immediately after I buy it. And then it'll rebound shortly thereafter. But, I just like to give everybody a heads up. But it's part of the game, and you have to learn to understand it. You won't buy something and everything will go up and to the right. It just doesn't work that way.
Mm-mm. And I like what you said about a lot of times for no fault of a company's own.
Mm,
It's easy to get wrapped up in individual companies and businesses and well, this business is better than that business and Uber is better than Lyft and Tesla's going to take out Ford, whatever. Industry forces and macroeconomic themes, they play a big role in
mhm,
knocking out entire sectors, entire industries. And um, I've been reflecting over some of my losses, but also some of my wins. I'm not all just beat myself up. And I notice that like when I buy an industry leader in an industry that's kind of beaten up, those have tended to do a lot better for me, and certainly a lot better than buying a cheap number 2
Mm,
when the industry is fairly valued or expensive. So maybe there's a lesson there. That's just completely anecdotal of me just looking over my track record, but it's just something that it seems like you see these ebbs and flows with industries,
mhm.
and I think it plays a big role in stock prices.
It certainly does. Certainly does. So the last one you wanted to throw on the pile was the game. This game is lonely.
Mhm. Yeah, it is. Look, I don't want to squash on anybody's dream. Like if you feel like you are meant to be a stock picker, a capital allocator, like and you feel that deep in yourself, then you're probably right. Like you probably are meant to be, right? The thing is that over this journey, the most fun and special and fulfilling parts of it have been linking up with other people and not so much the actual stock picking itself. So when I look at people we've gotten to meet on our journey, Dave, it's like Jeff and Jason, or Simone and Braden, or
Mm,
Brett and Ryan, or the Bryans, right? For Aldi Withers and
Awful.
those
Yeah.
all those guys. They're doing it right. Like find don't look at it just like, "Oh, I'm gonna try to make $1 million and that's it." Try to find projects that other people are doing that are related to your passions.
Mhm,
Link up with those people and create something, because that's what's exciting to me about these financial creators that are around us. They're doing it the right way. It's
mhm,
not all about, I'm gonna find my Berkshire Hathaway and I'm gonna take out the world and I'm gonna be the next billionaire. Not saying that any of us are like that, but just to take it to an extreme to say that if you can reframe and try to pursue things like that, I've just stumbled upon. I've gotten lucky, but for other people, if you can try to pursue that, I
mhm.
think you'll go a very long way, and I think you'll be very glad you did.
Yeah, I totally agree. I think that that will help alleviate some of the loneliness of trying to pick stocks for whatever reason. The stock market has become or is a solo sport, if you will, mostly because you're the one investing your money. Yeah, there are funds out there that work together. We mentioned Warren and Charlie and Nick Sweep and his partner Zach. They got to work together, but by and large, Peter Lynch solo act. Joe Greenblatt, Howard Marks, Monish Prabrai, Guy Spear. I mean, you can go on and on and on. They're all solo acts, and it there's a certain solowness to it, but also I think you're right on the mark is finding other people that you connect with and you can discuss things, whether it's business or whether it's investing, can be a lot make the game a lot more fun. And it's not something that I anticipated being hard about this,
Mm,
but it is certainly a lot harder to play the game when you're doing it by yourself. And so if you can find a way to connect with people, that will be an amazing way to do it. And we're doing that with Value Spotlight and with our community. And that's one of the things that I like the most about it is connecting with these really smart people like Jackson and Cheryl and Jennifer and Tyler and so on. It's, super amazing to be able to talk to those people on a regular basis because there's lots of smart people out there. And I think the more you can connect with them, the better you're going to become as an investor and a human.
yeah, you've been saying that since day one, right?
I have. Yep. I have.
Maybe it's starting to stick.
Yeah.
Maybe.
Water dripping on a stone.
Well, that is going to wrap us up for today. We hope you enjoyed this episode. Hopefully, you found something useful. And if you're a beginner, take at least one of these things to heart. We're just trying to save you some pain. So, as always, connect, learn, and grow with Value Spotlight. Peace.